The sudden collapse of two banks is sending shockwaves across the financial community. Silicon Valley Bank, which finances many tech companies, went down on Friday. On Sunday, Signature Bank of New York followed suit. The Biden administration took steps to make sure customers will have access to their money.
Look, the bottom line is this. Americans can rest assured that our banking system is safe. Your deposits are safe.
On Wall Street today, a number of bank stocks opened sharply lower. No trading for some banks because of the instability.
And we know the story is causing a lot of stress, which is why we invited Professor Paul Vaaler on the floor today. He teaches business and law courses at the U of M. Thank you for coming in to help us make sense of all of this.
It's a pleasure to be here.
Let's start at the beginning. So explain in the most basic terms what happened with these banks.
Well, simply speaking, it's an interest rate squeeze. Usually banks take deposits at certain rates and they lend at more and then they make money on the difference. Here it's the other way around. Banks were looking at an increasing federal interest rate, which meant that they had to pay more to their depositors, but their assets were at those low rates before, when COVID was on and we had interest rates near zero. So they had lots of treasuries and other securities that were yielding very low amounts. So they were stuck in a squeeze. And what happens with banks like Silicon Valley Bank is to get out of the squeeze, you sell some of those assets. Well, that puts even more downward pressure. So there was a kind of rolling ball that was heading towards collapse last week. It just happens so much faster now because of technology. You can move things with a flick of a switch as opposed to having to knock on the door like in It's a Wonderful Life, right?
So the federal government, we just heard from President Biden, is trying to avoid a banking crisis here. We've heard the term bailout before. What's happening in this case?
So what's happening right now is if you're a depositor, an individual depositor like us, you have FDIC insurance that runs up to $250,000. And that's always been the case. But there are many deposits at Silicon Valley Bank which are much more than that. They're in the tens or even hundreds of millions of dollars. And there are deposits from large venture capitalists, the individuals who fund all those new tech startups in Silicon Valley area. So they're interested in getting all their money out. And what's happened is that the Biden administration, the bank regulators have decided that in the interest of retaining the confidence in the banking structure, they're going to suspend some of those limits. So it looks like they're going to get their deposits back. Now, it's not easy street for everyone. If you're an unsecured creditor or if you're a shareholder in those banks, you're going to take a haircut or maybe be zeroed out completely. So it's not like there's anybody there that doesn't have risk. Lots of people have risk, and that's where we start with unsecured creditors and investors.
And to be clear, so American taxpayers are not footing the bill on this? How does this get covered, so to speak?
Well, not directly, right? So what the Biden administration has said is that we'll pay back the costs, if there are costs to this, by assessing fees on banks which are all members or virtually all members of the FDIC, the Federal Deposit Insurance Corporate Company. And so what that means, though, at the end of the day is all of us have accounts, all of us have banks. If their costs go up to some extent, it gets passed on to us. So perhaps indirectly, we're all paying a little bit more in order to make sure that the banking system is sound. And that's important to all of us.
I'm going to venture a guess that most of our viewers don't have accounts with these banks. They're probably with someone locally or some that we know, Wells Fargo, U.S. Bank. Is their money safe? How should they feel?
Their profile just doesn't fit Silicon Valley Bank. Silicon Valley Bank and Signature, they share in common heavy investments in high-tech businesses, cryptocurrencies, other types of things you would associate with Silicon Valley. That's not the profile of, say, a U.S. Bank or a Wells Fargo. They're well diversified. They're national in terms of scope rather than regional. The banks I think we should be watching for, the ones that were teetering back and forth in terms of share price today, were regional banks, banks that are in a certain area and they specialize in loans to certain type of industries, often in the high-tech sector. Watch some of those. I think that's where we want to make sure that we have the safeness and soundness and liquidity for them going forward because they're part of the system too.
All right. Well, we appreciate it.
Yeah.
It sounds like bottom line, most people, aren't impacted by this, and it's just something to watch.
Right. I think this is something we all want to watch as citizens. We all want to watch as taxpayers, and we all want to watch because it's in the interest of everyone to see the banking system be sound, and I think it is here.
Fantastic. Paul, thank you so much.